CNBC TV 18, celebrating 17 years of business leadership.
Welcome back to our special show on the RBI monetary policy, an important one, the first one after the Reserve Bank, after the government announced the demonetization of 500 and 1,000 rupee notes. Well, one of the key talking points has been how much of money has come back into the system. We know that the old notes as of March 31st was 14.6 trillion. We are all trying to extrapolate that as of November, the number would have been probably 15.5 trillion. But how much has come back? We had that exchange with Mr. Gandhi, the Deputy Governor of the Reserve Bank. Let's hear him out.
So how much notes have come back, the old notes?
The old notes that have come back, it amounted to, as of now, 11 lakh crores, 11.85. Almost 12 lakh crores, we can see.
Is that as of yesterday, sir?
11.85.
Well, that's what we have by way of reply from the Reserve Bank. Neeraj, will the discussion on dividend therefore become a moot point? Already almost 12 lakh crore and 4 weeks to go.
Yeah, I mean, it feels like that if we reach somewhere close to 13.5 to 14 trillion or 14 lakh crores, or even higher than that, that's what the markets are speculating. How much money is left out there which doesn't come back into the system, and how much of that then needs to be transferred to the government becomes a much less important in this entire exercise. I think equally important will become the figure of what is the amount of money that the government collects as a part of the disclosures that people make by way of unaccounted money. In any case, I think there is going to be a substantial benefit to the government. The number may not be as yet very clear, but the markets will keep on speculating as to what this number is and what is going to be the impact on fiscal deficit numbers as a result of that. Still not much clarity, but I'm thinking that somewhere close to maybe 1 trillion INR is certainly going to be the benefit to the government, whether it is by way of old currency not coming back or whether by way of disclosures and hence 50% of that getting paid as taxes.
Okay. We've got an economist joining in, so let's ask him what he makes of the impact on the fisc. Jahangir Aziz, the chief economist from JP Morgan, has joined us all the way from the United States. Jahangir, what will be the fiscal impact on February 1st when the budget is presented?
I think on the February 1st, I think the impact is going to be minimal because it will be difficult for the RBI to, at that point in time, say that this is the amount of cash that hasn't come in, and therefore I'm going to transfer that as profits, because that will most likely take much longer. And I would expect that even if the government estimates some amount of that flow coming in for the FY18 budget, we won't have any clarity on that till probably a few more months, because I'm guessing there'll be accounting issues, legal issues, etc., etc., etc. But again, the arithmetic has been made much more difficult by the fact that you still have MSS bonds to pay for that the government will be issuing to sterilize, and not to mention the fact that there is, things are happening on the FX reserves fund, which has been invested. Most likely, we don't have numbers on it in U.S. Treasuries, and U.S. Treasuries have sold off. So if you add all of them together, my sense is that you're not going to see very much on the February 1st budget. You could see some estimates being put in there. Probably, another 3-4 months later, once.
In net, Jahangir, will they collect more from in the current year itself in terms of tax revenues? As Neeraj is pointing out, there will be people who have declared their deposits and said that this is not tax not paid money, and therefore will there be some kind of a fiscal space available this year itself, or will that be taken away by companies reporting lower profit? What happens to current year's deficit and budget? What happens to next year with the data currently available to you? Is there space for a fiscal boost?
We are looking at the likelihood that you would probably have to cut back on expenditures to meet the 3.5% budget deficit, largely because the big items, privatization, disinvestment, that's the one that hasn't really happened. So yes, we can get something from the voluntary disclosure scheme that was higher than expected, but at the same time, these profit transfers taking place from RBI may not be as much. So as far as we are looking at the first quarter of 2017, we are expecting government spending to be pushed back in 2017 first quarter, which is the relevant quarter for this fiscal year.
Okay, so the guess of a fiscal boost next year is going to be tough, also because they have to bring down the fiscal deficit. So should we assume a big fiscal boost at all?
But that depends entirely on when this new working committee, what is the guidance they provide for the new fiscal responsibility act. We have no way of figuring out how they will translate this idea of fiscal flexibility. Okay.
From what you have read of the governor's statement, his answers in the Q&A, are you factoring in one more rate cut?
We are about 50 basis points of rate cut. This is what we had prior to this meeting. Going into it, we thought it would be done early. Now we were wrong, but we're still holding on to the fact that the circumstances in 1Q and in 2Q will be such that the growth numbers that the Reserve Bank are working with for the second half of the year, it looks a bit optimistic given the size of the shock that has happened because of demonetization, even if that shock is just temporary. So if you look at the numbers that the RBI is presenting, 7.6 going down to 7.1 for the full year. In the first half of the year, we already know it's 7.2. So arithmetic would suggest that the RBI thinks that the entire demonetization shock will cost the economy only 20 basis points in the second half of the year, which we think is a bit over-optimistic. We have a much lower number. We also have a much lower number on inflation, even after factoring in high oil prices. And therefore, I think the circumstances in 1Q and 2Q will be such that the RBI will probably have to deliver 25 to 50 basis points of rate cut.
Well, let me toss that to you then, Ashish. If there is indeed a cut, as people were expecting now already, and that is only postponed to February, all three of you, Srini also said that a cut is being factored in by the market. Then would you say in the first quarter, your best assessment was 25 basis as of now. For the first quarter, would you say that more lending rates can come to the system?
So, first quarter, there is a possibility. It also depends on how long the liquidity remains. It will be a combination of a rate cut as well as a liquidity. I think the way we are looking at things, and if you've seen the system, credit growth has been reasonably anemic. Given that, and given if the liquidity remains for a longish period of time, yes, you could have space for slightly more downward movement in lending rates in the first quarter. Beyond the 15 to 25 basis points range I spoke about it.
Well, at this point, let me welcome another veteran of the markets. We are being joined by Anant Narayanan, the head of financial markets at Standard Chartered Bank. Good evening, Anant. Thank you very much for joining us. Let me read one key statement on liquidity, which Ashish has only slightly alluded to. The surplus liquidity in the system. You are referring to the banks, but in the interbank system itself, the Reserve Bank has clearly said that it is committed to keeping liquidity operations neutral. Their own statement. The Reserve Bank is committed to conducting liquidity operations in pursuit of the objectives of the revised framework put in place in April to restore the system level liquidity to a position of neutrality. As the present surplus liquidity pressures abate. Anant, what is your sense? How much of rate cuts can be passed on if it is going to be neutral liquidity?
Good evening, Lata. So I'm going to put this in a bit of perspective before I come to your liquidity question. I think first off, the policy scores high on credibility, irrespective of what we think of the policy pronouncements. The reality is almost every stakeholder was almost egging the RBI and the MPC to go ahead with rate cuts. For them to withstand that and take a cautious stand, I think is just scores very high, and it's good news for everybody, including for FPI investors. Secondly, I think there's a lot of reason and a lot of justification for RBI to remain pat on the repo rate. The reality is the global markets are looking extremely uncertain, and given that those circumstances, financial stability does warrant that we show caution. Third is, I think the relief on the CRR front is very, very welcome for banks, and I think it's good news for everybody to cheer. The jarring note, I guess, is on liquidity, and from a personal perspective. One way I thought we could marry the short-term impulse of demonetization causing short-term pain with the longer-term requirement for caution would have been to allow surplus liquidity to remain in the system and therefore allow transmission to move on towards lower deposit rates, lower market rates, and therefore lower MCLR rates, maybe spurring some amount of consumption and investments in the short run as a relief to what we're going through right now. A move to liquidity neutrality, as reiterated from the April 2016 policy, can take away that impulse for short-term rates coming down. In fact, I would argue that a lot of the short-term rates coming down since November 8th was because the system was sitting with a lot of liquidity, even after the CRR impact, not knowing where to dump that money, and that was bringing down deposit rates and short-term rates. That could be reversed. Today, already we saw short-term rates going up by 25 basis points, and maybe transmission will kind of stop at its tracks right now. So I personally would have preferred some leeway on liquidity, maybe moving away from neutrality to a bit of surplus till such time that the demonetization impact is digested by the market. That could have helped transmission of lower rates and maybe a bit of consumption coming back. That's not to be, but you can't have it all. Okay.
Well, Srini, let me toss that back to you then. Since you are the biggest banker here, at this point, we will have the country's biggest banker speaking in just a while. But what's your sense? We have Srini with us, don't we? Okay. We don't have Srini with us now. We'll just reconnect with him. What's your say? Ashish, you are expecting, even if the interbank system liquidity is kept neutral, if there is a rate cut in February, you would think more than 25 could be passed on?
So as I said, the numbers could be anything there. What I've said, what can be passed on, I said that there would be some amount of passing on without a rate cut till Jan. If there is another rate cut, yes, there is a possibility of some more of it being passed on.
Okay. Neeraj, what did you make of the growth assessment? Jahangir has clearly said that he expects that it's an overestimation on growth and an overestimation on inflation as well, which he expects will tick much lower. How have you looked at both these numbers and your expectations of rate cuts?
See, I feel that the full assessment of the impact of demonetization on growth, I think, is anybody's guess right now. People are basically working on the fact that most of the major industries have reported about 20 to 30% reduction in their sales at least, and some even more. And a lot of small and medium enterprises have actually talked about complete fall in sales, or actually a substantial fall in sales. So the actual number is anybody's guess, but we know for sure that there is going to be some impact on the growth. It's quite likely that this growth impact is likely to sustain for about 2 odd quarters before we come back into normal life. Now, if you assume that we are going to see approximately anywhere between 1% to 2 percentage point growth impact for the 2 quarters, then the full year impact is roughly between 50 to 100 basis points. The fact that Reserve Bank has actually chosen to bring it down from 7.5 to approximately 7.1, it feels like that there is a little bit of an overestimation, but the reality is that we will come to know as the data filters in a little bit later on what is the full impact of this.
And so, therefore, in the first half, how much are you expecting by way of cuts?
I'm sorry, could you just repeat?
So how much are you expecting by way of a repo cut, you think?
I think repo cut at this stage, given what Reserve Bank has said, probably 25 basis points in February, and then wait for some more data to see whether the inflation fall is persistent and whether the growth fall, whether the market, the economy has recovered or not. Also look and see what happens to the US rates and what happens to the currency. I think those are all very important factors in pricing in anything more than 25 basis point at this stage.
Okay, so you don't see the 10-year going below 6%, say at least in the first 6 months of next year. In the next 6 months, does the 10-year go below 6 at all?
With this policy, no. I think we are probably going to be, the best case to my mind is 6 to 6 quarter. If the chances, or if the data is such that we get to see a slightly more weaker, inflation numbers or better inflation numbers, and it feels like that there is a reduction in the core inflation, and the effect of the demonetization is a lot more sustained than one, everybody's thinking about. Probably there will be a reason to revisit it, but at this point in time, it feels like that maybe 6 to 6 quarter is the range where we could see lowest.
All right, gentlemen, we have to take a break. We are back again with a few more questions. We will also have Arundhati Bhattacharya, who spoke to us earlier today, and her views on the monetary policy.
CNBC TV 18, celebrating 17 years of business leadership.